All right. So then the CPI is the measure of inflation because it is the overall pricing of goods. This idea that it's the average of what goods cost across a section. You talked about the idea that it went up a tick, it's staying up. What's the motion there?
So actually the consumer price index, the goal from the Fed is a 2% CPI. So 2% is the goal. We have been way above that for a long period of time. It was up to 9.1% at the high, and that was a few months ago. And we've all just been hoping that it was going to come down. The Fed has jacked up interest rates like we've been talking about, which should lower spending. But the big takeaway is that inflation is stubbornly high. And everybody's hoping that it comes down, but it's just not coming down. It's at 8.2%. But over 8% is like 40-year highs for our country. So the big thing is that if you go back a few months, we had kind of a bump in the stock market. It was a little rally. And there was this optimism that the Fed could create what's called a soft landing, where they wouldn't have to raise interest rates so much and that spending would come down and inflation would just come down. And the air had just been taken out of that balloon and just pounded and stomped on. That balloon is in a million pieces right now in the economy because inflation is much more persistent and stubborn and much harder for us to tackle than the markets were hoping and that most people thought and that the Fed thought. And so the Fed uses the overall CPI as a benchmark, but so food prices and energy prices are more volatile. And so they remove those because they want to see if the core products are going up and down because those are much harder to change. And you guys can fact check me on it. If somebody wants to do a quick search, look up core CPI. I think it was over 6%. I think that's the highest that it's been. And that really has the Fed concerned. I mean, look at what the Fed's doing, right? How else can they bring inflation down other than raising the borrowing costs, raising interest rates? Prior to 3 months ago, 6 months ago, somewhere when they started raising rates, they hadn't done a 3/4 point raise to interest rates one time in 28 years. And they did that. That was the first interest rate raise that they did. And since then, I think it's been 3 straight of 3/4 points.
It's been insane.
So like they are throwing everything they can. They are literally signaling they do not care about sending our economy into a recession. And when a bear market happens, the average loss in a bear market is 36%. We haven't even gotten to an average bear market. And I hope people just see this in these incredibly poor economic indicators and these poor indicators for the stock market. And also the bond market too, because the reason bond prices are falling is because the Fed is raising interest rates. They're inversely related. So if you think the Fed is still going to put pressure on interest rates rising, that means bond prices are going to go down. This is the time to become a not your average investor, to think differently, to explore other asset classes. Tell your friends and your family to not just stay in the market blindly without thinking about it. This is the time. Invite them to this show.